Audio test. Having problems with this software. Little scalp over here. Show you why it did that. When you look at the New York open only charts, you got the moving average 200 and a rising 20, so I expect a bounce back. That's exactly what we got. So I'm all done for the day. I got appointments. So anybody trading? Should be uh should be a green day for the indices. Let me try to pull up some stuff here. We had the sell-off. We're a little bit oversold, and we have support right over here. So came back to the tails. So now we need, well, we don't need, but I think a small pullback. As long as we don't take out this big red bar, we should be fine. But looks like we gonna be taking out this tail. Maybe we'll test this 20,000 on a weekly chart. So as you can see, this bar is support. So that's why we see a little bounce back. The top of it, and the range, and then the bottom are the strongest support points. So we almost came down to it. So today's only Tuesday, so this bar is still got 3 more days, not including today. Actually, well, today's the third day, so then Thursday, Friday. So we'll see what happens. The monthly. So as you can see, we came down to the 20-day moving average and stopped. That makes sense. Anybody trading this? You're welcome. Let's see.
pullback. It's at least a moment to stop and say, if it's going to get much worse than this very soon, you probably have to see a little more tangible evidence of outright economic weakness, of financial conditions tightening a lot more elsewhere. Credit's not really acting up too much. So I think that's the situation we're in.
So we posting these two double tails. So we should see a bounce back again, like I said. These moving averages, the flattish moving averages, act as support as well. So it makes sense to go up. Okay.
Of that and say, okay, maybe that means that in fact you can have a fuller bounce. Any initial rally is going to be suspect at this point, and obviously it's going to be headline dependent. But Leslie, I'll say it again: if this was all and mostly about tariffs every day, different stocks would be leading us down. It's just not that. It's just not like GM and Ford going down every day. It's obviously one of the things that's weighing on the macro outlook, but it's not necessarily just that.
Well, it's all related to this unwind, which we'll go into greater detail later in the hour. But it's this idea that there was a crowding effect into certain names, things that were seen as beneficiaries, really, of the Trump trade, and then the reversal of that when the headlines went out of favor, when there were filings that revealed that a lot of funds were in the same positions to a similar magnitude, leverage was high, everybody sold out, and then you kind of had this rush for the exit over the course of a few days. Now the question is whether that capitulation is done, if there's more wood to chop there. Gross leverage is still pretty high. Some of that could be just the dynamic by which they calculate it relative to kind of what equities have done, how people have sold out of their positions, and how people have taken on additional short exposure in light of all the uncertainty.
By the way, the losers right here we're talking about on the Dow and even the S&P, it's the defensive stuff. So yes, the indexes look like they've just exactly. They did that bounce is dissipated. Yesterday it was kind of Mag 7 growthy, hard hit stuff that was rallying. If you could put together 2 days, it ratifies the idea that okay, that forced selling momentum stampede out maybe has abated to some degree. So we'll see if that works. All right, fresh inflation data coming in better than expected this morning. As we were mentioning, Steve Leisman here with the breakdown and more on why recession fears are growing on the street. Hey, Steve.
Hey, good morning, Mike. Yeah, the better than expected CPI this morning offering the best possible setup you could think of for a series of price hikes that could be coming into the system from tariffs. It's a better starting place for the Fed and its ability to cut rates if there's economic weakness and it's needed. Headline 0.2, better than the 0.5 we had last month, a tenth better than the estimate. Core 0.2, that's half of what it was. And you can see what's happened. The year-over-year rate has come down, but perhaps not where it needs to be for the Fed to feel super comfortable about cutting that 3.1% on core, probably a half a point higher than it would be in the PCE. Meat, poultry, fish, and eggs, that was 1.6%. That was a reason for the increase. Energy services, used cars and trucks also higher, but you got some relief on gas. And airline fares was probably the biggest reason for the number coming in below expectation, but that doesn't feed in to the PCE number. Economists at Raymond James writing, quote, there will be some inflationary impact from tariffs, but it is still not showing in the overall numbers. However, even if tariffs impact inflation, the underlying disinflationary trend remains intact. That's important. The outlook for inflation in the months ahead and how the Fed might react, that's one of the uncertainties markets are dealing with. It has some concern about recession. The recent failure of old recession guides means forecasters flying somewhat blind. You can see there the inverted yield curve and the sawmill didn't work. Recession predictions under Biden ended up being wrong most of the time, or all of the time, actually. Tariffs look like they will have the biggest effect on the supply side, and it's rare for that to be a source of recession. Paul McCulley, economist, says almost by definition, a recession is driven by the demand side of the economy, which gives you the excess capacity on the supply side. Talk to Mike England from Action Economics. He says predicting recessions are problematic because it comes from places you don't expect. Recessions tend to occur from what they call exogenous shock, something that from the outside that's not expected. The economy can adapt to something that's slow moving and well known. The difficulty in adapting, lack of clarity for what is going to happen in tariffs, taxes, and the level of government spending. I don't know if you guys saw, but Justin Wolfers put out what he says is the world's first ever intraday tariff level chart from yesterday.
Intraday?
Yeah, because it went up and down and back up.
Yes, of course.
And Lutnick is on the tape saying that if you think the process is chaotic, you're being silly. But okay.
Yeah. One thing that I did see yesterday, Jim, was your hit with Kelly, which went viral and gets backed up to a large degree in the Journal op-ed pages today. Any reaction to it?
Well, it appeared as if I was speaking for a lot of people who find the process very chaotic and slightly insane. I was not calling the president insane, of course, but I think that there's a way to do this in a way that is less disruptive. And you can say it's a win for Trump when he beats up on the minister of Ontario. But, you know, I mean, that's like not really a fair fight. Is it a win for Trump if you've shaved $3 trillion off of the S&P 500 in search of some unknown goal? You put these steel tariffs in place. There's research, Carl, you know, that shows that you may save some steel jobs, but you end up losing jobs in places that use the steel. And that is those are far bigger industries than the steel industries. Not that I don't feel bad for the steel industries. It just doesn't feel well thought through, Carl. It feels like if you're going to make a major change, if, for example, where's the White House's economic estimates on how all this works out? How many jobs will you create? How much will it cost? Who's going to lose jobs? What happens when you raise the entire cost structure of the North American supply chain? Well, I know what happens. You've got to erect tariffs in April in order to essentially protect the North American supply chain where you've raised the prices. How long until we get those manufacturing jobs? That will happen when companies start to build in the United States. If there was an estimate or some kind of sense, Carl, that this thing had been thought through, my opinion, my take would be completely different.
All right. Well, that's why Holtz-Eakin is quoted in the Journal today, calling it a horrific start for the economic policy
Carl,
team.
do you remember when we used to get a briefing book from the White House on a major economic change? It was this thick. It had a fact sheet on it. It had the economic estimates. It had how many jobs. And then, of course, you could rake the administration over the coals, or you could say they were right when the numbers came in as they expected or below they expected. But they put their money where their mouth is. They created an estimate. Kevin Hassett, I'm talking to you. Where are the estimates? Before you do these policies, how do you put a tariff on Canada in place, and then 3 days later you talk to the car companies and then you take it off? Justin Wolfers is not lying about an intraday tariff chart. We may have an intraday tariff chart today.
Yep, we'll see if we need it today, too. Steve, thanks. Steve Leisman, we'll talk in a bit. Let's get some more on the trade tariff turmoil. Canada now to impose reciprocal tariffs. Our Megan Casella is live from D.C. with the latest, and they're not the only ones, Megan.
They're not the only ones, Carl. That's right. So first it was the EU overnight announcing some retaliatory tariffs. And then just in the last few minutes, Canada now saying they will be putting 25% tariffs starting tomorrow on about $20 billion in U.S. exports. They say they'll mostly be targeting steel and aluminum, but they're also going to hit some other U.S. imports. They say that'll include computers, sports equipment, and cast iron products, just as some examples. So expect more details to come from Canada. And I would also expect more retaliatory announcements to come today, guys, as other countries start to digest this move, because remember, this hits everybody across the world. So we do expect to see more retaliation. And now getting back to where Steve left off, this is the rare policy move where we have a pretty good idea of what the economic impact will be. Trump's first term, when he first imposed these tariffs on most, at the time, steel and aluminum imports. That was back in 2018. He then later carved out a handful of countries, in part because of the economic impact that we saw. The upshot at the time was that there was some modest help for domestic steel and aluminum producers, but all steel and aluminum users were hurt. And as Steve was saying, since that's a far larger subset of the economy, the net impact overall was a negative one. So just to put a couple of numbers behind it, some research from the Federal Reserve, it found that the tariffs boosted employment in manufacturing by about 0.3%. That's how much it helped producers. But the rising input costs then dragged down the same sector's employment in manufacturing by a little over 1%. Retaliation pulled it down another 0.7%. So then on net, the impact was about a 1.4% hit to manufacturing. The Council on Foreign Relations says that was a direct loss of about 75,000 manufacturing jobs. And to put it more simply, economists at the Peterson Institute estimated there was a cost to consumers of about $900,000 for every one job saved or created in the steel industry. And remember, guys, those tariffs impacted only a fraction of the steel and aluminum imports that are seeing new duties today. So we can expect that impact to only multiply now that it's a bigger move. Guys.
Megan, it felt like in Trump 1.0 that the tariff policy was really solving for what you just laid out, job preservation, preservation of manufacturing, this time it feels a lot more muddied. It feels like, one day it's about fentanyl, one day it's about, making sure that U.S. manufacturing remains competitive and jobs are saved. What are you hearing in Washington in terms of the priorities that they're looking for? Because that confusion makes it difficult to assess, what exactly is going to happen next. If the fentanyl issue gets solved, then are tariffs going away? Or if the manufacturing preservation, if they find workarounds, does that go away? But without really knowing what they're solving for, it makes it kind of challenging.
Absolutely. You are hitting on what I hear the most about from industry, from companies, from consumers, is that it's not clear what the goal is with these. And because of that, people don't know how to react. They don't know what the overarching priorities are. You're absolutely right. First, it was fentanyl. These tariffs are about national security. The reciprocal tariffs are about fairness and a level playing field, and maybe the trade deficit, and maybe just some longstanding gripes with the EU and with Canada particularly. Those are the ones we hear the most, where the president seems to have some personal frictions or some personal.
Looks like we're might be forming a head and shoulders here. So be careful down below.
One, remember a few weeks ago, they said they were never going to take the Canada and Mexico tariffs off until there were 0 fentanyl deaths in the U.S. Obviously, we didn't get to that point. Then they said they talked to the car companies. They didn't want to hurt them. That's how they removed about half of those. So we just don't know. And you're right that industry does not like that they're using tariffs to try to solve for non-economic issues. We will have to see how that develops.
We will have to, Megan. Thank you very much. As we head to a break, here's our roadmap for the rest of the hour. We'll discuss the tariff fallout for automakers and also speak with CEOs of one of Canada's largest steel makers.
Plus, what happened when hedge funds unwound their Trump trades? We'll talk about it.
And Bridgewater's founder Ray Dalio warning about America's mounting debt problems. He has for a long time. We've got more of Sarah Eisen's interview with Dalio coming up as Squawk on the Street continues after this.
A reality.
Welcome back. Canada announcing 25% reciprocal tariffs on some U.S. imports. This comes after President Trump's steel and aluminum tariffs went into effect, adding to uncertainty for the auto sector. Here with his take on the road ahead, no pun intended, for the automakers is former Ford CEO and CNBC contributor Mark Fields. Mark, thank you for being here. So there are a lot of different ways that the expected tariffs will impact the auto industry. Can you just help level set for us where we are right now and how it's impacting corporate decision making in the sector?
Well, Leslie, right now, in every boardroom, in every automaker, any investment decisions that are on the table, they're taking a timeout because there's no clarity. Usually, when you're making an investment, you have a set of assumptions, economic assumptions, cost assumptions. And right now, those assumptions are worthless given the changes. When you look at what's happened, just in the last week in terms of tariffs going on or tariffs being delayed, it's a bit like playing whack-a-mole with a blindfold on. And in that case, everybody's taking a pause. But from the industry standpoint, I think what's happening, with the tariffs right now, first thing they're doing is first keeping a running tally of either what's been imposed or what has been proposed to be imposed. Secondly, they're stockpiling the best they can, particularly in the vehicles they're producing in Canada and Mexico, and maybe stockpiling them and not shipping them across the border until they get some clarity. And, just on the cost side of the house with these aluminum tariffs, you have to put into perspective that, there's hundreds of pounds of aluminum in a vehicle, whether it's doors or lift gates or hoods. And even since 2018, and I know in the previous sector, they talked about the impact of these aluminum tariffs, there's more cost in vehicles today on aluminum, and Canada supplies 50 to 75% of the aluminum into the U.S. So costs are going to go up. So automakers are grappling with how do they deal with that? Do they pass it on to consumers or do they eat it?
It seems like a convincing argument, especially since it's a multifaceted impact for the automakers. And it seems like based on that, the price increase would be passed to consumers. Is that correct? And if so, do you think that would get the administration's attention and maybe recalibrate, open up talks and solve this thing without tariffs?
Well, it's going to depend on the automaker. Let's just take into account right now the aluminum tariffs that are in place. Some automakers may have more sources of aluminum in the U.S. than others, but those that don't, they're going to make a judgment whether they'll take the hit on the margin or pass the cost on consumers. And what they're facing on the consumer side is prices are off their peak of highs last year. But still, at an average payment for a new car for a customer of about $750 a car, the automakers are going to have to make that judgment. Do they pass that cost on to consumers? Do they decrease the incentives? Or do they take production out of their production schedules and take the hit on their profitability for that? So that's the kind of calculus and the decisions that's going on right now in the automakers. And then they have to look forward. Right, because as you know, the Trump administration has said vehicles that are assembled in Mexico and Canada, there's a month delay on whether those will be tariffed at 25%. So you have to think forward as well. So it's a lot of uncertainty, and automakers and business in general do not like an uncertainty, and that's why a lot of investment decisions and production decisions are going to be deferred.
Mark, presumably the industry is trying to plead its case on some level here with the administration. What do you think they may specifically, in terms of tangible steps, be asking for? Is there a way to exempt, intermediate goods as they go back and forth across the border as part of the manufacturing process, or is there some other way that they might be trying to preserve a little bit of their economics?
Yeah, I think there's a couple of things going on. Let's take the aluminum tariffs right now. With Trump's the administration's strategy of trying to bring jobs back to the U.S., to build an aluminum smelting plant in the U.S. Is going to take years. And David, these plants are 3 or 4 football fields long, so they're really big. And it's not only the time, but it's the cost of the energy aluminum is very energy intensive. And guess what? Where you're going to place these plants, you're probably going to have to place them near, data center or server farms, which use up a lot of energy. So there's that piece of it. So I think they're going to have that discussion with them and say, listen, this is just not possible. But I do think, as I've said before, I think the end game for the Trump administration is they want to renegotiate the USMCA agreement, which was the previous NAFTA agreement. I think Trump has regrets that he didn't ask for more U.S. local content. So I think the automakers are going in there and saying, listen, let's tackle that trade agreement and give us a glide path in terms of a timeline to bring some specific components or assembly jobs back to the U.S. But you have to give us some time, because without that, it's just basically going to destroy the financials of the automakers in the U.S. and make them even more uncompetitive globally. And they have to compete globally, not only here in the U.S.
Mark, really quick, what happens if in 4 years there's a complete reversal in tariff policy? Then what?
Well, I guess we'll be on this interview talking about that on the same things. And that's why I think Trump really wants to renegotiate the USMCA agreement, because if that agreement is in place, then the next administration can't go in and change that only until the time that it expires.
All right. Thank you, Mark Fields. Really appreciate you breaking all that down for us.
Great. Thank you.
Still ahead, the biggest risk that Ray Dalio sees ahead for stocks, and no, it's not about tariffs. As we go to break, check out the biggest drags on the Dow this morning, led lower by Verizon. Some of that defensive trade that's been in place last couple of days getting unwound a bit. You see McDonald's, which had a banner day yesterday. Stay with us.
Streaming on Peacock.
Welcome back to Squawk on the Street. The street's biggest thinkers, leaders, and CEOs meeting in Singapore this week as CNBC kicks off its annual Converge conference. Our Sarah Eisen caught up with Bridgewater co-founder Ray Dalio alongside Salesforce's Mark Benioff and asked about this recent market unwind. Take a listen.
Broadly speaking, Ray, we have seen a bit of an unwind in the U.S. market. There's this idea, and President Trump said it himself, that he wasn't specifically trying to avoid recession, and he seemed cool with the idea. They're rebalancing everything when it comes to trade, potentially the U.S. government deficit. Does it make you think differently about the U.S. stock market and our prospects for recession in the U.S.?
Well, I think the first thing is the debt issue. We have a very severe supply-demand problem. So we think there's debt, and some people think, oh, we'll handle it because we've handled it so far. I don't think they understand the mechanics of debt. By the way, I've written the draft of a book that anybody can see on social media, on particularly LinkedIn, that goes through the mechanics of the debt. But there's a supply-demand problem, so that they have to sell a quantity of debt that the world is not going to want to buy. And that's a set of circumstances that is imminent. Okay, that's paramount importance. Then we're going to have to deal that the deficit must go from what will be projected now to be about 7.2% of GDP to about 3% of GDP. Otherwise, there will be a supply-demand problem. Okay, that's a big deal. You are going to see shocking developments in terms of how that's going to be dealt with. Things that may not have happened in our lifetimes, but things that have happened throughout history.
Meantime, Sarah also asked Benioff about what he's hearing from clients.
Is a trade war healthy? Because the market's also going down on that. I mean, Mark, you sell to so many enterprise customers, talk to so many CEOs. I wonder what you think of the latest tariffs. They're coming from left, right, Canada, Mexico, China, reciprocals coming on April 2nd. What are the CEOs you're talking to saying about it? And is that uncertainty leading to action, lower enterprise spending, for instance, and a potential recession?
Well, again, I think that, you line up what you're saying with Ray. It's about the what and the how, and in the what is, yes, do I believe reciprocity is good? Reciprocity can be very good, so you have clarity, if one country's treating you this way, you're treating that country with the same reciprocity.
So you're on board.
But it's the how also. And the how is very important. And you've got to put the what and the how together. And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict. And I think that plays into then Ray's, worldview.
High levels of volatility and conflict, Mike. I guess we're again talking not about policy endgames, but policy execution.
Execution, side effects, and maybe unforeseen circumstances. I mean, I think you have to look at it a little bit through the filter of, look, Ray Dalio is kind of always sees a potential debt crisis on the horizon. He's written multiple books about that. But it's not misplaced to talk about the fact that our trade deficit means we export a ton of dollars out of this country. They come back in terms of demand for our assets, including Treasury debt. Right. I mean, that's one of those things that balances the global books, that if you actually made progress on curtailing the trade deficit, does that mean effectively cost of capital goes up? Right now, you're already seeing the sort of yield differentials move around, the currencies move around globally. So I think that's something you have to keep an eye on and recognize that it can be a source of instability in the interim.
So I've actually read the draft of his latest book, and that is the argument that he makes, this idea that, if you shun some of the international people who have been big buyers of our debt, what does that mean in terms of the interest rate levels and going up from there? He calls it a debt death spiral, this idea that, the worsening credit picture could lead to less demand for the debt, leading to higher interest rates.
But if they turn their back on the dollar, just put 100% tariff on it. It's a very circular argument.
Also, nobody knows what that threshold is. 7% was probably thought to be way beyond the threshold before, and here we are with a 4.2% 10 years. So it hasn't yet come to bear. We'll see. As we head to a break, NASDAQ up more than 1% on the day. It is the standout. Check out the biggest gainers on that index this morning. Tesla leading almost 6% higher. We're back in a moment.
And make it count.
Welcome back to Squawk on the Street. I'm Angelica Peebles with your CNBC News Update. Secretary of State Marco Rubio says the U.S. is taking a 30-day ceasefire proposal to Russia today after Ukraine agreed to the terms yesterday following talks in the U.S. and Saudi Arabia. Rubio says the U.S. will strongly urge the Kremlin to end all hostilities. Meanwhile, Ukrainian and Polish officials confirmed this morning that U.S. arms deliveries have resumed following yesterday's breakthrough. A U.S. official says a person of interest has been identified in the week-long search for a missing University of Pittsburgh student. She vanished last week while on spring break in the Dominican Republic. Local authorities say the case is still considered a missing persons investigation. And the owner of a cargo ship that collided with a U.S. tanker says its captain is a Russian national. British authorities say they do not suspect foul play in the crash. Police arrested the man in England yesterday on suspicion of manslaughter by gross negligence over the fiery collision. Mike, back over to you.
I'll take it, Angelica. Thank you, Angelica Peebles. Watch the markets here. We started out with a nice posture, a pretty good tone, where really only the defensive sectors were in the red, but we have lost a little ground. Financials have turned red, industrials, some materials. We continue to see tech carrying most of the water today, but it is a long session. Bob Pisani's here with more on what he's watching, Bob.
Well, it's good news and bad news. I mean, look at the market here. The good news is the CPI helps, and potentially it opens the door maybe for the Fed to ease a little bit, but we don't know how much the tariffs or anything like that are baked in. The bad news is, well, they're selling into the rally, folks. Look at the S&P 500. We started out, what was the high print here? 56.42. It was right at the open. There's the high print. We sold right into the whole thing. It is good to see sector-wise. Okay, it's good to see a little more risk on. Good to see technology leading, for example. That was there today. Consumer discretionary, that looks up. That's an illusion. That's all Tesla. That's what that is. Almost the entire sector is down except for Tesla. And you can see risk, more risk-averse sectors like healthcare and consumer staples are lagging there. There's Tesla, which is the reason that the consumer discretionary sector is up. And nice to see Micron and NVIDIA bouncing and Broadcom. This is why we got technology up. That's a good sign. But again, these are all off of their highs. The market laggards, boy, the transports just look terrible these days. Delta, United, and we have new lows all over the place in transports. CSX 29, that's a new low. FedEx is a new low there, 239. And there's other stuff that JB Hunt's at a new low, Old Dominion's at a new low. So the transports are really not telegraphing positive news on the economy right now. The big debate right now, and the reason they're selling into the rally, they can't figure out whether is this a slowdown or a recession. And it's still not clear. And that's what's got the market on edge. So the S&P 500, you know, all within roughly 1% of a 10% the correction from its recent high. The reason the market's in a tizzy is that the tariffs could be the agent that tips the economy from a modest slowdown into a recession. And for stocks, there is a big difference between a slowdown and a recession. In a slowdown, growth declines, but the economy doesn't shrink. In a recession, the economy does shrink, literally by definition. And the stock market reacts very differently between these two. And this is why the market's in a tizzy. In a slowdown, defensive sectors like consumer staples and healthcare, they do well, but technology stocks can also do well in a slowdown. This is a slowdown, you see, potentially not disastrous, but it's very different in a recession. In a recession, defensive sectors are usually flat to down. This study goes back to 1960 on recessions. But tech stocks tank by, you see, about 20% on average. Put up the second part there, you see technology down 20% on average. And so the issue here, and the big problem that everybody's got uncertain about is, what is this here? Is this a recession, or is this a slowdown that we're entering right now? And day by day, people can't figure out. And what the market really wants, I've been saying this for 2 weeks, is that they want the tariffs to go away. That's what they want. And the crazy thing is a tweet can change all of this. So normally when we talk about slowdowns, we talk about fundamentals, we bring in Leisman, we get all this boring stuff about where the economy is going. And now it's like, well, the tweets can change everything. And that makes people a little bit crazy every day.
What do stocks do during stagflation? Because we're hearing...
Oh, much worse than that. Yeah. You want to go back to 74 and 72 and 3 and 4? No, you just, everything is down. Then you're selling consumer staples and everything. So hopefully that's not what we're entering right now. I'm doing the optimistic scenario. See, we already, it's perfectly reasonable. They're 10%. There we are. There is high evaluation issues, and there's a somewhat slowdown in the economy. That's a standard garden variety correction. You would be perfectly comfortable having that conversation right now. But you throw in the tariffs, that's what tips everything over to the other side. And that's why we can't figure out where are we, why we get these everyday gyrations, and why you get selling into what should be a decent rally today.
Yes, the intraday tariff rate, as Leisman put it last hour. Stay close, Bob. Okay. See you soon. Bob Pisani. Coming up next hour, Oakmark's Bill Nygren's with us. Says to bet on financials here. We'll talk about why at 11 a.m. Eastern Time. And after the break, the CEO of one of Canada's largest steel producers, Algoma, talking tariffs as the company pauses all shipments to the U.S. He's going to join us next.
So I guess I was right. I called for a head and shoulders right here. I would have entered right here below this green bar. And just call it 60. Alright, just call it 60. 20, 40. That's 100 points here. It would have worked, right? So all this news, CPI news candle is completely erased. So it looks like we might see low support in this area around 500. If that breaks down, next one is 400.
Canada today announcing 25% reciprocal tariffs on some U.S. imports. Meantime, the president's 25% tariff on all steel and aluminum imports kicks off today. And as a result, our next guest company has paused all shipments to the U.S. Michael Garcia, the CEO of Algoma Steel, one of the largest steel producers in Canada, joins us this morning. Michael, thanks for the time. Appreciate it very much.
My pleasure.
Can you talk about the preparation you've made for this particular day?
Sure. Well, the pause in shipments is really temporary in nature. Yesterday, around midday, we picked up news that there may be a 50% tariff as of midnight last night or this morning. That changed by the end of the day to 25%. And there's talk about a further follow-on meeting happening on Thursday between Premier Ford and Mr. Letnick. So I think for a matter of a couple days today and maybe tomorrow morning, we're going to pause shipments because really the tariff, when it's in place, is triggered when our product crosses the border. So we have the ability, without impacting our customers, to pause shipments. We have trucks rolling across the border every day. We're right here on the Canadian border in Sault Ste. Marie, Northern Ontario. So we'll pause until Thursday to have a better understanding of where we are.
We were at this desk about this time yesterday when that 50% number crossed the tape. It obviously threw our assignment desk and our production booths into a bit of a tizzy. Can you give viewers a sense of how it resonates at your desk and in your meeting rooms?
Sure. We were literally in a meeting reviewing our forecast for the remainder of 2025. We had several different scenarios in place with 25% tariff, 50% tariff, 0% tariff, and we were discussing, the different scenarios and what we would need to do as a company to react. And we went from our base case being 25% tariff and a lot of discussion about that to, okay, now our base case is 50% tariff. And this was happening real time as somebody saw the tweet. And so that changed the tenor of the conversation for sure.
Can you explain your calculus behind pausing the shipments as opposed to maybe passing through higher cost to customers or eating a bit on the margins? I'm just curious how the thinking went into the decision to pause.
Well, it's really a reflection of how dynamic and uncertain the situation is. There's a tremendous amount of difference between a 0, 25, or 50% tariff. And we did this last week when the initial 25% tariff was in place. We started hearing different reports that, there's discussions happening. We saw the news. I think it happened with Mexico first, that the 25% tariff was going to be delayed until April 2nd, or maybe it was the automotive sector tariff that was going to be delayed till April 2nd. So we paused, I believe, on Wednesday and Thursday. And then by Thursday, we had news that the Canadian tariffs were also paused if you were compliant with the 2019 USMCA agreement, which we are. And so by pausing shipments for a day, any ton of steel that crossed the border, that didn't cross the border when a 25% tariff was in place, avoided a 25% tariff. When if you think about a ton of steel, if your revenue on that is $1,000, that's $250 that we avoided, and you multiply that by thousands of tons, that's a lot of money. So this is what we've found ourselves doing in the last couple of weeks.
Michael, I guess the question would be, if the 25% remains in place for some time, what does it do, let's say, in market share terms? Is there capacity domestically in the U.S. to make up the gap for the higher cost imports? Or is it really just going to be about who shares the cost and killing overall demand at a higher price?
Well, when you're talking about steel flows between U.S. and Canada, it's really not a significant part of the market share. I think the U.S. consumption of steel is around 119 million tons. The integrated market for steel in between Canada and the U.S., it's very integrated. So we have raw materials like iron ore and coal and scrap metal that flows across the Canadian-U.S. border to steel producers on both sides of the border. The Canadian steel producers ship about 6.5 million tons of steel into the U.S., and U.S. steel producers ship about 3.5 million tons from the U.S. into Canada. And we ship it to customers that then make products like durable goods and automobiles and oil country pipeline tube, and that then gets shipped across the border. So it's very integrated. I don't think there's any evidence that since free trade has been in place for steel between Canada and the U.S. for several decades, that this amount of steel flowing back and forth and the net flows has killed U.S. industry or damaged workers or damaged the manufacturing sector. In fact, I think there's a lot of evidence that it's benefited the supply chain in both countries over that time period.
Hey, finally, Michael, you seem like a pretty candid type. What to you is a doomsday scenario, at least regarding U.S.-Canada trade?
Well, a very significant and concerning scenario is a 25% tariff in place for a length of time with certainty that it's going to be in place and no substantive conversations going on around finding if there are, that problems or issues with the free trade that I described that's been in place for several decades. I would hope that the people come to the table and have a fulsome discussion around improving or tweaking or addressing specific issues with that free trade, like happened in 2019 and with the signing of the USMCA agreement, which I believe President Trump called the best trade agreement ever.
Yes.
But if 25% is in place for a long time, that's a serious concern to companies like Algoma Steel.
Michael, appreciate it. Good context for viewers who are having trouble just keeping up. Thanks very much, Michael Garcia.
My pleasure.
Yeah, very helpful. Coming up, is the future of housing 3D printed? Let's get to Diana Olick with more on what's ahead. Diana.
2 years ago, we came here to Texas to see the very start of what would be the world's largest 3D printed community. Well, it's done and we're back. We'll take you inside coming up next.
Pause to mark the 5th anniversary of the 9/11 attacks. The information that the Central Intelligence Agency has obtained by questioning men like Khalek Sheikh Mohammed has provided valuable information and has helped disrupt terrorist plots, including strikes within the United States. For example, Khalid Sheikh Mohammed described the design of planned attacks on buildings inside the U.S. and how operatives were directed to carry them out. That is valuable information for those of us who have the responsibility to protect the American people. He told us the operatives have been instructed to ensure that the explosives went off at a point that was high enough to prevent people trapped above from escaping. He told us the operatives have been instructed to ensure that the explosives went off at a point that was high enough to prevent people trapped above from escaping. The explosives
Quick reminder, tomorrow morning, do not miss a big interview here on Squawk on the Street. Our Sarah Eisen will talk with the Treasury Secretary, Scott Bessent. That begins at 10 a.m. Eastern Time.
Well, as the nation continues to struggle with a shortage of affordable housing, the answer, like everything else, may lie in technology. We're talking about 3D printing on a high production scale. Diana Olick is just outside of Austin, Texas, Georgetown, Texas, with more on this. Hi, Diana.
Hi, Mike, and we are in the model home for what is now the world's largest 3D printed community. And yes, the walls do feel like Widewell corduroy. Lennar, which is the nation's second largest home builder, partnered with Icon, a 3D printing company, to print 100 homes here, and they did it much faster than it would have taken conventionally.
We have a durable product here that if you look at its wind resistance for hurricanes, its fire resistance for fire-worn areas, the ability to adapt modern product to what we need for the future in housing, in building a healthier housing market, is amazing.
Icon started with 2 printers but grew to 11, and by the second year, they were squeezing out 2 homes per week, each printer doing the job of more than a dozen construction workers. The systems operated 24 hours a day. The only part not printed is the roof. Now, the homes have all the amenities you would see in a regular Lennar community, and each is solar powered. They come in 2- and 3-bedroom models starting at just under $400,000.
We wanted tall doors, taller ceilings, cement floors somehow, and this home just had everything. So really just a combination of the energy efficiency, the practicality, the price point, and then the aesthetics.
Now, this was an experiment for Lennar, so their costs were slightly higher as they worked out the kinks. But Miller told me, and this is a first on CNBC, that Lennar is already working on its second 3D printed community, which will be about 7 miles from here. It will have twice as many homes, and they'll be able to build them much cheaper than they did these homes. And just a note on tariffs, Icon's CEO told me that all the concrete used in this development was sourced domestically. So there is your housing tariff hedge. Back to you guys.
We'll take anything to undo this housing shortage. Diana, thank you. Diana Olick. Money Movers begins in just a few minutes.
pause to mark the 5th anniversary of the 9/11 attacks. The information that the Central Intelligence Agency has obtained by questioning men like Khalid Sheikh Mohammed has provided valuable information and has helped disrupt terrorist plots, including strikes within the United States. For example, Khalid Sheikh Mohammed described the design of planned attacks on buildings inside the U.S. and how operatives were directed to carry them out. That is valuable information for those of us who have the responsibility to protect the American people. He told us the operatives had been instructed to ensure that the explosives went off at a point that was high enough to prevent people trapped above from escaping. He told us the operatives had been instructed to ensure that the explosives went off at a point that was high enough to prevent people trapped above from escaping. The explosives
Well, I called it here. Head and Shoulders to 500. And I said we might be testing the 400s. And look what happened. This red bar told me we are going to 400 at least. So there's a lot of support in this area. So we'll see what happens. But that's it for this stream. Don't forget to subscribe, hit the like button, and hit the bell notification icon. And we'll see you in the next video or live stream. Take care.